just to highlight on our half-year results, so just reminding everyone we're a end-of-year balance. And the half-year result, we delivered our earnings of 7.18 per security. That was paid to our security holders on the 29th of August. And at the bottom end of our guidance range, we're delivering about a 5% yield, just to sort of put it in snapshot. In terms of our costs, we continue to manage our costs. We're running at 23 basis points for our management expense ratio. And so we are one of the lowest expense REITs in the sector. And that, of course, comes down to the fact that we have these triple net leases in place. 95% of our portfolio, being the Viva portfolio, operates on triple net leases and helps us to keep our costs low. Our portfolio now is at $2.5 billion. That's 464 assets located right across Australia, primarily in line with where the population of Australia is. And the weighted average lease expiry for our portfolio is just on 12 years. So very long leases, very stable tenants with very secure income. And 95% of our leases have fixed 3% rental increases. In terms of our balance sheet, we've kept our gearing low. At the end of the half, we're at 33%. That is within a gearing range of 30 to 45%. So we're operating at that lower end of our gearing range. Our weighted average debt cost is 3.83%. And as you guys would be aware, we raised new equity in February, which you also participated in. In terms of our portfolio growth, I talked about the fact that since inception, we were sort of 425 properties at sort of 2.1 billion. We're now 2.5 billion, 464 properties. I think the key is we still maintain that 75% metro properties, 25% regional properties. Very happy with that mix. And our mix by state is very much in line with where the population is located. In terms of growth, what we offer, I guess, is sort of a 3 pillars of growth. So the first is the fixed 3% rental increase. So if I buy nothing, effectively do nothing, we're still going to deliver a 3% income growth, assuming we keep all our costs sort of in line with what we say we'll do. So that's the first piece. The second piece is through acquisitions, and we've completed about $45 million of acquisitions in the first half. We have 21 million that we have expenditure associated with those that will come in the second half, and we have a really strong pipeline of acquisitions. And the third pillar to the growth is really around what we're calling sort of development and asset utilisation. So we have funded through a number of properties in the first half, and that's something that we've done that's relatively new. But what those fund-throughs are delivering is effectively a 7% return on the funds that are expended. I'll talk a little bit more about that in 1 second. In terms of our portfolio, we've continued to diversify the portfolio. When we started, you may be aware, we were all Shell service stations in our network. We now have a number of Caltex properties, 7-Eleven properties, and Liberty Oil properties. So where the properties that we can find meet our sort of investment criteria, we are somewhat brand agnostic, albeit, we're sticking to sort of the top tier brands at this stage. What I would say we're looking for in our acquisitions is the underlying quality of the real estate. So what is the property that we're buying? Where is it located? What's the traffic flow like? How are the assets located? And what's the underlying real estate worth? Because ultimately we're buying real estate. Secondly, we're looking at the lease covenants on those properties. So who's the tenant? What's their credit quality like? How long are the leases that are associated with those properties? And what are the rental escalators and how close is that to what we have in the rest of the portfolio? And the third piece we look at is sort of how it fits in terms of that geographic mix. Again, I said we've got sort of in line with population. You're unlikely to go and see us buy 50 sites in the Northern Territory, for example. We're very much skewed to where the population is. And then ultimately, we're looking to see if those properties can deliver further returns in terms of capital growth. So now we have about 7% of our portfolio that's non-Shell. Now, it's not a huge amount, but you can see that we are providing some diversity. I thought I'd also just touch on the sort of development fund-throughs that we've done with Liberty. I think Liberty is, as you may know, is 50% owned by Viva Energy. and we've had a long-term strategic relationship with them. I've worked with the principals there for many years, and they are very good property developers. These guys have been in business for 40 years together, and they build an excellent quality product. So the way we work on these fund throughs with Liberty is we basically upfront agree what the location is, what the facilities are going to be, and what the offer is going to look like. In doing that, we agree and we buy, Viva Energy REIT will buy the land. We'll agree a takeoff price at the final completed stage of the property, get independent valuations for each of those, and then we provide the funding for Liberty to complete the builds as the developer. Having Liberty be the developer for us means that we're not taking the development risk, so to speak, but equally they are the final tenant. So by being the final tenant, it means A, they build a quality product because ultimately under their lease, they're responsible for the maintenance and upkeep of those properties. So it's worthwhile them building something properly. They're not building it to flip it. And secondly, they are motivated to get it delivered on time because they want to operate it. And once you start operating, that's how you generate cash. We do it on a coupon fund through. So there's various different stage gates during that development. And the key thing there is that we are getting a 7% return on each of those leases during the coupon period and then at the end period. The only other thing I wanted to touch on today was guidance. So we've reaffirmed our guidance that we published in February, and that was for earnings growth of between 3 and 3.75% over 2008. So we're very confident that we will deliver that. As you guys know, our business has a very predictable cash flow. Our acquisition pipeline remains strong, and we've got plenty of balance sheet to be able to fund any further acquisitions.